So we're talking in the prior segment about the need to diversify. I'll give you the statistic that when we look at, we kind of say, this is a market that might be getting concentrated in a small handful of companies. So don't know if you're aware of how dramatic those numbers are getting, but if you look at the S&P 500, which is obviously intended to be an index of 500 companies, what you'll find is that it's just 10 stocks, so 2% of the 500, that accounts for almost a third of the overall performance of that index. So why does that happen? Well, we'll explain that next on Dollars and Cents. Welcome back, of course, to our program where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on Sunday mornings, News Radio Orlando Network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web, with over 13,000 downloads of our program on various channels, whether it be iTunes, Spotify, YouTube, whatever the case may be. We're there. Check us out. Make sure you subscribe. Simply search for Nelson Financial Planning or Dollars and Cents with Joel Garris. My name, of course, then is Joel Garris, certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So S&P 500, right? 500 different stocks, but that's not how it works. See, the S&P 500 is a weighted average, a weighted index. So that means that the bigger you are, the more you account for the performance of the index. And so today we're seeing sort of a split, if you will, where a very small handful of companies are driving a tremendous amount of the performance. The statistic we were giving earlier, you've got 2% of the companies in that index driving nearly a third of the performance of the index. Folks, that speaks to a lack of diversification. The last time we saw statistics similar to that, it was 1999. And if you don't recall what happened in 2000, 2001, it did not end well. So be aware when we talk about diversification, it's not just enough to be like, oh yeah, I own an index fund or whatever the case may be. You've really got to dig deeper and see, okay, well, what amount of my portfolio is constituted in my top 10 holdings? Folks, if that's getting to over 30%, that really speaks to not being as diversified as you should be. Your top 10 holdings in any portfolio should never be breaking above 20%. If you own the S&P 500 index, then your top 10 holdings are accounting for over 30%. So be aware that this issue of diversification is one that is lurking in the background, particularly today, given the massive run-up of a small handful of companies, and we know them as the FANGs. If you're an investor, or you've maybe heard that label on in the media, it's the companies like Facebook and Amazon and Netflix and Google. Those are the FANGs, and throw an Apple in there as well, Microsoft, another one kind of in there. Those companies, Netflix, again, you know, they're the 8 or 10 companies that we all can kind of rattle off the top of our head. Those companies, though, are driving a significant portion of the market. So from a diversification point of view, make sure that you are aware of the impact that they can have and the lack of diversification that they can bring to the table if you are not looking at your portfolio and drilling down and looking at what are my top 10 holdings inside my portfolio that ultimately show me what it is that I actually own. If you own a bunch of funds, the reality is that those bunch of funds may all own the same kinds of companies. So you got to drill down and really specifically look at the top 10 holdings. As we continue in this segment, I want to come back to a segment that we were doing in the last segment a couple of weeks ago. We sort of ran out of time, and it was some tax tricks for 2020. And so we talked about the notion of converting IRAs to Roths, and certainly looking to take advantage of that, particularly this year when interest rates are low. Not interest rates, tax rates are low. The reality is that there were two caveats that we want to make sure that folks understand. Number one, you've got to make sure that you've got ready funds available to pay for that. That is a taxable transaction that's going to appear on your taxes. And unlike in previous years, if you don't like the tax result, you can undo it. You can no longer undo a Roth conversion. A recharacterization, which is what it was called previously, no longer allowed. Similarly, beware the ripples, whether it's more of your Social Security get included as taxes or whether it's losing the loss on a rental property. Understand that when you do a conversion, it's income, it's ordinary income, and that can have some pretty big ripple effects throughout your return. The other thing we talked about, qualified charitable distribution, great technique. If you've got a required minimum distribution and want to make gifts to charity directly, then that ultimately reduces down the amount of the required minimum distribution that you have to report on your taxes. Again, RMD suspended for the year 2020. You can still do a qualified charitable distribution though, so certainly something to think about between now and the end of the year. So other items that we sort of ran out of time on, one of which has to deal with gifting. And understand that you can gift someone up to $15,000 annually per person. So your spouse can give to your child and their spouse and their kid each of $15,000. So ultimately that means that you can obviously give a lot more money than you might have originally thought without any tax implications. No tax implications to you, no tax implications to the recipient, along with the fact that you can obviously give unlimited direct amounts for tuition and medical expenses. So the IRS has stated that there will be no clawback, but at the end of the day, the estate tax exemption at $11,580,000 per person is very much subject to change. So if there is some gifting and estate planning that you want to try and do, we would encourage you to do that between now and the end of the year, because starting next year, we may see those estate tax exemptions be dropped and be dropped significantly. This conversation about reducing those down to 5 million, so 11 million down to 5 million, that's a pretty big change. And so the reality is that may very well happen. It's scheduled to happen regardless in the year 2025 because all of this is subject to phase outs. So it's going to happen. The question is whether it happens next year or whether in 2025. But certainly something to be thinking about between now and the end of the year as to whether you take advantage of those higher estate tax limitations and numbers. And then lastly, make sure you're updating your estate plan after the Secure Act. We talked about that a little bit on the program earlier. Secure Acts fundamentally changed the stretch IRA, so that really may mean that you need to adjust your amount of money or estate plan that relates to your IRA. So with that, we'll wrap it on up and get on out of here. Thanks for listening to the program here on Dollars and Cents. This is Joel Garrison, News Radio WFLA Orlando.